Before we move on to the fixed income market, I want to first get your perspective on the MPC decision. Clearly, it's almost a week now, but I think you still have some reservations about that decision or whether or not it was good. We did see the MPC decide to keep rates on hold at 12%.
Yeah, well, thank you for having me this afternoon. I must tell you that it wasn't really a surprise for the Monetary Policy Committee of the Central Bank of Nigeria by keeping their policy rates at a staple condition. You need to realize that most of the effect we are seeing in inflation is part of the preemptive strike they've taken at the beginning of the year or even towards the end of last year. But what you need to understand concerning inflationary pressure is that whenever that you see that prices are increasing, the rate price increase is not really the inflation, but rather the rate at which these prices are increasing. So CBN actually has a good reason why they decided to keep MPR, where despite a drop, we had an inflation from 12.9 to 11.7. So I think that looking at maybe what is happening in the core inflation, which forms part of our major economy here in Nigeria. So I may reason with them by saying that, yes, let's watch and see what is going to happen. But in the real sense, if you can advance an argument on the other side, one could say that this is the best time to drop MPR so that we'll see if we can instill growth in the real sector of the economy. But they have a better say when it comes to this.
All right, so clearly you think that was the right move, and we'll continue to watch that inflation number to see, and of course see what they will do at the next MPC going forward in November. But let's come back to the fixed income market, and of course there's a lot of talk about the bond market, the rally we've seen. We've seen that fall back a little bit over the last few sessions. Yesterday was a bit of a mixed bag. How was the bond market today across the curve?
It's a welcome development when they announced that the Nigerian FGM bond will be included in the JP Morgan Emerging Market Index. At the same time, you will see that a whole lot of fund managers will be smiling because it makes it easier now for them to link most of the portfolios they are managing. Instead of managing as a fundamental indexation, they will go call a index-link portfolio. But at the same time, we need to realize that there is a very good premise that allowed this JP Morgan to include us in their index. The reason is that the Central Bank of Nigeria earlier this year actually removed the restriction we have in fixed income flow. So we actually need to watch this. So going to what has actually happened in the market, we've seen a situation where the rally, talking about the capital appreciation, reversed immediately. Though to some extent it was a sort of regulatory induced, because people have some little rumor that the foreign investors are actually trying to sell down. At the same time, with the auction they did last week, where CBN issued the 5-year bond and the 7-year bond on a yield that's higher than what the market is selling. So the normal thing that will happen is that when you come to the secondary market to sell, those securities will naturally adjust to meet the yield at which the primary auction was sold. That's exactly what happened.
Let's talk a bit about that last auction, because I think some people were a bit disappointed at the uptake of bonds. Your thoughts on the auction results?
Yeah, well, what you need to understand these days is that most allotment we may see may not really go to the major PDMM, talking about the primary dealer and market makers. It may actually go direct to some of these foreign investors. But the issue is this: when it comes to the rate at which the stop rate at which CBN, DMO released those things, it's really a shock to the market, because we're talking about 80 basis points and 70 basis points for the two issues they did. It's really a very good matching that created a sort of panic in the market, and that was actually what led to the capital depreciation we witnessed within these few days. But it's really telling on the market.
But I thought the rates for these issues, that the DMO monthly issues, were actually market-driven. To some extent, it's a function of the rates at which investors would like to bid for those bonds. Isn't that the case?
Yeah, the issue is this. One thing is to agree at a year, but you also need to watch that the federal government and the Central Bank of Nigeria, to some extent, we are witnessing a sort of realignment between the physical policy and the monetary policy. I don't think the federal government president is ready to actually pay that high yield. At the same time, you expect that for the fact that they want the foreign investors to be around here, they also need to keep this at a level where it will be appealing to them. I've been talking about the CBN side. So you can't do it in a situation where it will be so down for them to start talking about negative return on investment. So there's a sort of balancing on this. So that's actually what is happening. So at the end of the day, what you may see is that with the domestic dealers, while we are praising our own portfolio based on our prices, talking about mark-to-market, because this we are talking about the third quarter of the year, where we are supposed to at least present the result of some of the regulatory authorities. Meanwhile, some of these foreign investors are looking at having a positive return on their investment, benchmarking whatever with their domestic rates in their place when they look at international parity conditions.
Okay, but your thoughts on where yields will go from here? We've seen it come down, for instance, in 2017 to about 12.7%. Clearly, we've seen a huge rally in the bond market. But do you think, like I've put this question to quite a number of analysts, your thoughts, do you think it will get to single digits? Do you think we will see the yield curve below 10% at some point?
No, I think there's still a little buying pressure in the market. From what happened this afternoon, at the close of bond trading today, we've seen yield firmed up from lower 12 to almost 13 point something. So what it means is that the buying pressure is still there. So I think at the end of the day, we may still see yields drop further if the pressure continues. But what I need you to understand is that it may get to a peak where if it puts a pressure on our currency, we may see a massive exit.
Right. Of course, that is the big question. If the Naira was stable, and of course, with the oil price where it is today, I think there's very little risk of that. But okay, let's talk about liquidity in the money market. Clearly, that to some extent impacts the bond market. What kind of pressures are we seeing right now? There has been talk of tightness in the system. Is that still the case?
Presently, the liquidity in the market is really okay because the issue of FAC inflow that came in and the maturity of Treasury bill, we're expecting almost about 186 billion, but talking about 27.9 Treasury bills. So I think presently the market is highly liquid, and I don't think we may expect any tightening. It should be from now to February, early February of next year. The system may not really suffer a whole lot of liquidity tightness, because I think CBN, to a very large extent, when they were doing the stabilization of CBs that are selling last year, they were able to give enough bills that put the system in a very liquid condition.
All right, now this may not be directly related to the interbank market, but of course, as you know, the power reforms have hit a real milestone today. We've seen the sale of 5 companies, 3 companies generating $633 million. That is that if investors make a good on their commitments to make those payments. Now, there's a feeling that we could see some pressure in terms of this fundraising. We've seen it in the past when with the GSM companies in 2001, where we saw some liquidity, some tightness in the money market as a result of many of these companies trying to raise cash. Do you think we may see that scenario play out once again?
It may actually come, but maybe that could be one of the things that could drive the issue of corporates raising bonds in Nigeria. But before that can be done, I think the issue of rating agency having credible organization to actually check this company before they come out in the stock exchange to actually raise funds from the public. But it will be a welcome development that will actually deepen the fixed income market. And this time that we're talking about taking our bond to stock exchange, having our full bond index, it will be a welcome development, because presently I think we are still trading, what is trading actively in Nigeria is a sovereign bond. But if I would diversify to corporate, that would deepen the market. And it makes it easier for people to construct portfolio that will have a mix of several types of bonds.
All right, Humphrey, thank you so much for joining us. We look forward to speaking to you again. Humphrey Uzoh is joining us from Diamond Bank, giving us a perspective on the Nigerian fixed income market.